My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make a little money. My job, not just entertain, but put all this in perspective. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Look, everybody knows I get up real early, right? 3:30 is my target time. Now, some of that's to do work. Some of it's to get the zeitgeist of the day. And most important, a lot of it's for the top 10 things to watch memo I write every day for Investing Club members. That's where I highlight what the big shots are thinking when it comes to the mountain of research I get every day. And in the absence of earnings, it's that mountain of research that matters. You see, the season isn't going to get rolling until Friday. I like to peer at multiple pushes, multiple upgrades, and price target hikes, because right now, in the absence of earnings, they often determine the action of days like today, where the Dow ultimately dipped 53 points, S&P inched up 0.07%, NASDAQ advanced 0.14%. See, like so many other days lately, most of the big calls were about the sainted stocks that we talk about all the time. The Apples, the Lillys, the Nvidias, the Microsofts, and they're all positive. And you know what? I don't know whether you can really understand this. Most of the time, these research recommendations are working. They have the intended effect. They're moving stocks higher. The endless buy recommendations for the tech titans are really the major reason why we keep getting these new records, both in the market and individual stocks. It is a chief reason why the tech tone is so darn great so many days of the week. The cheerleading, it is impactful. The stocks, they continue to roar. So let's review just one day. One day's bounty. So you know why stocks just keep working their way higher. It's been a couple of days since Nvidia's had any champions. But today, the analysts ran a full-court press against any remaining skeptics. Yep. An analyst at KeyBank raised his price target from 130 to 180, talking about how the demand for Nvidia's new platforms is extraordinary. And by extraordinary, I mean insane. It's the Blackwell formulation. These chips and their accompanying systems have turned out to be even more popular than we expected when NVIDIA first rolled them out at the GTC conference, the big trade fair that I went to earlier this year, where I couldn't have been more bullish. I wasn't bullish enough. Now, plenty of people wonder if Blackwell could cause a major problem for NVIDIA, because if the new chips are so powerful, why would you ever go buy the current iterations when you just wait for Blackwell to ship volume in the fall? But just as the amazing CFO Colette Kress told us repeatedly, there are no transition worries. The current iterations from NVIDIA work well with Blackwell. So there's been this continual ordering right into the Blackwell cycle. Positive, virtuous demand for Blackwell, which allows generative AI to be fed not just text, but video, is so strong that you have to wonder if it will be far bigger than initially thought. It doesn't hurt, by the way, that Blackwell's more of a software platform than just a chip inserted into some sort of ecosystem, not of NVIDIA's own. NVIDIA makes the chip and the ecosystem, and you know what that means? That means higher gross margins. KeyBank is talking about $200 billion in data center sales for 2025, which is $60 billion more than the consensus that people are looking for NVIDIA. Data center investment is accelerating. JP Morgan put out an estimated customer mix for NVIDIA's BIS chips. Get this, Microsoft's taking 28%, Meta 14%, Amazon, Dell, and Supermicro each taking 10%, Google 7%. With customers like that, it's no wonder they can charge upwards of $35,000 per chip. Next, Melissa's Ben Rice, by the way, Ben has been right the whole way on NVIDIA, says that money managers are actually underweight the company's stock, meaning they need to buy more if they want to kind of more accurately mirror the S&P 500. Do you think you want to show investors that you were underweight one of the greatest performing stocks of all time? So they've got the rest of the year to do some buying before their clients find out. I also think, by the way, that we're finally working through the churn that came from NVIDIA's 10-for-1 stock split. I told you that would take a while. It took a little longer than I thought. But if it were just NVIDIA, well, I'd be talking about something else right now. And that's why when I saw Bank of America had a cogent note on the Apple App Store this morning, now predicting 14% growth for Apple's fabulous service revenue stream, I recognized we were getting a solid reason to feel optimistic even up here for Apple, something that could spur more price target bumps tomorrow. I also think, by the way, that the F1 movie, that's a blockbuster being put out by Apple Original Films, could be the first production to really move the needle for Apple TV Plus streaming services, a blockbuster that it costs less than going to the theater to take Apple Plus. I think it's going to mean something. Meta and Google needed some good news to justify their recent romps, and Goldman Sachs promptly gave it to us, saying that things are looking up for their digital advertising businesses. Digital brand advertising is very strong and will benefit from easier comparisons versus last year. Goldman also likes what it sees with the deployment and utilization of AI across the digital advertising space. Again, a justification for current and future prices. That's what the research departments are doing. Last night, we got this call from Arthur in New York. I don't know if you caught it. He was worried about the government maybe breaking up Amazon. No, I don't think that's likely. That's what I said. But right on time, we have a note from Jefferies giving us the sum of the parts valuation for Amazon. Apparently, it'd be worth 18% more than it is now if they broke it up, thanks to the strength of Amazon Web Services and Amazon advertising. And no, the stock is not going to be hit by all the stock that we learned later tonight Jeff Bezos sold. That's just something that people do, okay? Jefferies' Brent Thill points out that their cloud business is going gangbusters, accelerating from previous quarters. He says advertising is a stable 20% grower with optionality from Prime Video. The massive logistics spending for the pandemic years is behind them. Meanwhile, he notes that Amazon keeps gaining market share by reducing friction with the consumer, getting product to the well, you know how quickly it comes now. Incredibly, the stock's selling at a 25% discount to its 10-year average. Base case Amazon, $235. Stock's currently under $200. Incredible. Hey, Phil was busy last night. He also put out this survey of 40 U.S. chief investment officers on cloud spending. Can you imagine those guys must be more fun than a barrel of monkeys, don't you think? And they're opening their wallets big time. Apparently, cloud spending is biased to a double-digit increase, with AI being a material driver. Oh, and get this. Microsoft's Azure is edging out Amazon Web Services in the survey, 45 to 43%. Remember when Amazon had the ball to itself? I mean, it's incredible. Think about all these. These are the stocks that dominate the market. Today, I heard someone say that this is just like the concentration of companies that led the market in the year 2000, which of course means... Now, this is one time I'm happy to be a grizzled veteran. Age isn't worth much except when it comes to history. So I'm going to tell you that unlike the leaders of the dot-com bubble, these are insanely profitable companies that I'm talking about, and they keep innovating and keep giving you reasons to buy, and they are rational reasons. Sure, I don't want people to simply pay more for the same business over and over. That's called multiple expansion. Don't like it. These companies are pivoting constantly, giving you actual legitimate reasons to boost price targets. That wasn't the case at all back in 2000. We were constantly paying more for shares in companies that brought nothing new to the table until the quarter, and then they just issued disappointment after disappointment after disappointment. They were the opposite of these businesses. The bottom line, there are many things you can call these magnificent mega-cap companies, but unlike 2000, ridiculously overvalued, ain't one of them. Dan in California. Dan.
Mr. Cramer, thank you very, very much for everything you do for the little guy.
Thanks, Dan. Thank you.
My question is regarding Celsius, and it has dropped considerably in the last 45 days. And the only thing that I can find out is that one of the people who owns 10% of the company sold $25 million worth of his stock. That's all I know, and I don't understand why it's dropped so more.
Well, there had been a decline in the growth rate, very subtle, in the last few weeks, and there was also a story about how their stuff was being heavily discounted at the club stocks, you know, at the Costco kind of thing. And that's what's keeping it down. The numbers that came out this morning were more positive. I'm not giving up on Celsius. I think it's a very interesting story. And thank you for the kind words. Let's go to Mark in Washington. Mark.
Hey, Jim. Thanks for taking my call.
Of course,
I've been holding on to Eaton for the last 2 years and watched a great run up. Is it time to sell, or should I go longer?
No, you want to own Eaton. We put a very nice position on for the Charitable Trust, and we've been telling people, look, when you hear data center growth, Eaton should be one of the ways you played it. I know it is stalled here, but remember, it's not going to be one of the sane at 7. It happens to be a great industrial that I think is going to have a very good next couple of years. Barbara in New York. Barbara.
Hi, Jim.
Barbara.
I'd like to know what you think of Constellation, CEG.
Oh, Constellation Energy. Okay, we like Constellation Energy very much. That's nuclear. It's clean. It's what people want. I'll give you two for the Charitable Trusts. We own Constellation Brands, and we said yesterday we had to trim a little because we just didn't like the fact that they kept the wine and the spirits, but I'm liking both Constellation Energy and Constellation Brands. There you go. All right, now, look, there's a lot of things you can call these magnificent mega caps, but ridiculously overpriced, ain't one of them. We have money tonight. Tesla shares, I know you care about that, are electric of late, but could the rally continue? I'm going to give you my take. Then I'm going bargain hunting in the retail space, and revealing it's time to circle back to two stocks that I really like, and I'm not going to mention their names, Best Buy and Dick's. And roller coaster of profits, I'm breaking down what the merger between Cedar Fair and Six Flags means for you. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.